In this last lesson of Module 4 of the free online course, Corporate Finance for Lawyers, you will have the chance for a recap of the module via a set of 15 multiple-choice questions. All the answers with a short explanation will be added below in the comments. Lesson 31, Capital Structure Basics, Debt versus Equity Fundamentals. What is the primary difference between debt and equity financing? Ad-EPT financing involves ownership, while equity financing does not. Debt financing requires repayment with interest, while equity financing does not dilute ownership. Equity financing is always cheaper than debt financing. Debt financing is risk-free for the borrower. Which of the following is a key advantage of equity financing? It avoids fixed repayment obligations. B. It is always cheaper than debt financing. C. It increases financial leverage. D. It reduces the cost of capital. Lesson 32. Why leverage matters in loan covenants. How does high leverage affect loan covenants? It reduces the need for covenants. B. It increases the likelihood of covenant breaches. C. It eliminates the need for financial reporting. D. It has no impact on loan covenants. What is the primary legal implication of violating a loan covenant? The lender may demand immediate repayment of the loan. B. The borrower gains more control over the loan terms. C. The borrower can renegotiate the loan without penalties. D. The lender loses their legal rights to enforce the loan. Lesson 33. Equity versus debt, control, risk, and legal implications. Which of the following is a legal implication of equity financing? A. It increases the company's debt obligations. B. It dilutes ownership and control of the company. C. It requires fixed interest payments. D. It eliminates the need for financial reporting. Why is debt considered riskier for shareholders compared to equity? Ad-EPT increases the required rate of return on equity. B. Debt reduces the company's overall value. C. Debt eliminates shareholder voting rights. D. Debt financing is always more expensive than equity. Lesson 34. Debt-to-equity ratios in legal agreements. What does a high debt-to-equity ratio indicate? The company is primarily financed through equity. B. The company has a high level of financial leverage. C. The company has minimal financial risk. D. The company is unlikely to face bankruptcy. Why are debt-to-equity ratios important in legal agreements? They determine the company's tax obligations. B. They assess the company's ability to meet financial covenants. C. They eliminate the need for financial reporting. D. They reduce the cost of capital. Lesson 35. Financial covenants, drafting and enforcement. What is the purpose of financial covenants in loan agreements? To ensure the borrower maintains certain financial metrics. B. To eliminate the need for interest payments. C. To reduce the lender's legal rights. D. To increase the borrower's control over the loan. Which of the following is an example of a financial covenant? A. A requirement to maintain a specific debt-to-equity ratio. B. A clause allowing the borrower to delay repayments. C. A provision for issuing new equity without restrictions. D. A requirement to eliminate all debt obligations. Lesson 36. Subordination and security interests. What does subordination in debt financing mean? A giving priority to equity holders over debt holders. B. Ranking one debt obligation below another in repayment priority. C. Eliminating the need for security interests. D. Reducing the interest rate on senior debt. What is the purpose of a security interest in debt financing? To provide collateral for the lender in case of default. B. To eliminate the need for financial covenants. C. To prioritize equity holders over debt holders. D. To reduce the borrower's repayment obligations. Lesson 37. Preferred stock and legal rights. What is a key legal right of preferred stockholders? A priority in receiving dividends over common stockholders. B. Voting rights equal to common stockholders. C. The ability to demand repayment of their investment. D. The right to eliminate debt obligations. Lesson 38. Convertible securities and legal complexities. What is a convertible security? A debt instrument that can be converted into equity. B. A type of equity that guarantees fixed dividends. C. A security that eliminates financial risk. D. A loan that cannot be repaid in cash.